Thank you so much, Todd. Hi, everyone. Good evening, good afternoon, good morning, wherever you may be. My name is Christopher Vecchio, Senior Currency Strategist with Daily FX, here to talk to you today about trading the news, harnessing event-based volatility. One of the main questions that we get across our desk when clients call in is, what can we do to take advantage of XYZ event? It could be a Fed rate decision. It could be the US non-farm payrolls report. It could be something related to Brexit. If it comes up on our economic calendar, we're getting questions about it. And so at the start of this new year, as we're trying to get the fundamentals down, not just, fundamentals versus technicals, but get the basics down pat so we have a foundation of knowledge from which we can work the rest of 2021. We're going to start off with understanding why we want to trade event risk, what's the philosophy behind it, and more importantly, what we can do taking that understanding and turning it into an actionable trading strategy. Before we get started, of course, we need to run through the general risk disclaimers, things that you've probably seen before. I'm going to let these linger on the screen for just a few seconds, unabated without my voice, and then we will move on. All right, we should be good to go here now. Again, thank you so much for everyone coming out today. We're going to be covering the basic concepts, how we can find the right event and currency pair, and then ultimately talking about a potential strategy, managing our risk. When we start with basic concepts, we're starting with the question, why trade events and data? And I actually want to jump into some behavioral finance here, not to take the wind out of Brian Caprice's sails. He has a terrific presentation coming up, and I highly recommend that you stick around for it later today. But when we talk about trading events, we're actually expressing our belief about the efficacy of different types of approaches to markets. What do I mean by that? Well, in traditional finance, there is this concept known as efficient markets, which you can boil down to basically meaning the price is right. Security prices reflect all available information in markets, and there's no free lunch out there. You can't outperform consistently on a risk-adjusted basis. There are three different types of efficient markets under the efficient market hypothesis. There's weak form, semi-strong form, and strong form. Now, weak form market efficiency speaks to the fact that prices reflect all past public price and volume information, and therefore technical analysis won't work. Neither will fundamental analysis, nor will inside information. Unless, of course, you have material non-public information, which is not something that we as retail traders typically have access to. The semi-strong form of market efficiency suggests that prices reflect all public information. Technical analysis and fundamental analysis, like looking at a company's balance sheet, that won't give you any value added. You have to have inside information, that material non-public information, to make your trade work. And finally, the strong form. The prices reflect all information, both public and private. And so even if you have inside information, it won't matter. The market knows it. Of course, for us as traders, we don't believe in any of these things. We don't think that there's no way to not have an edge, that we can have an edge by looking at technical analysis, that we can look through companies' balance sheets, through a country's macroeconomic indicators, and discern some insight that will give us an opportunity in a marketplace. And of course, I think all of us would agree that if you have inside information about something, chances are you can make money on it. In fact, I'm going to bring up a real world example that's just happened recently. Philip Lane, the ECB policymaker, after European Central Bank meetings last year, was calling up 11 different institutions and hand-holding them through an explanation about what was going on from the ECB's perspective. In fact, these 11 institutions, after a phone call that Philip Lane gave to them at the end of March 2020, proceeded to inspire these 11 institutions to take up positions in European sovereign debt, to go long Italian debt in particular. What happened 11 days after those phone calls, less than 2 weeks later? The European Central Bank came forward and announced their bond buying program. That was 11 days after an ECB meeting in which they said they're not here to, quote, narrow spreads, unquote. So those people who had that access to Philip Lane, and Philip Lane called them up and said, actually, ignore what Christine Lagarde had just said to you, said to the markets. We're going to be announcing a new program shortly, get long European debt. Those people did quite well. Every single institution made money on those trades. So just as a real world example, I don't believe in efficient markets. And more importantly, I don't think that you should either when you approach situations, because if you do, then you really don't believe in the technical analysis that you are practicing. You don't believe in the macroeconomic analysis that you are practicing. And a layer on top of this, has anyone ever seen trading pits? Have you ever seen what an open outcry pit looks like? If it could be the Ring in London, which is closing now, or the old Chicago trading floor. People wearing multicolored jackets, vests, screaming at the top of their lungs, different hand signals, emotions. That's not a calm, rational environment. So let's throw away this. Let's throw away the notion that we can't find an edge in the marketplace. And I think that we can find an edge in the marketplace because we are a collection of individuals that are making decisions in different phases at different moments in time, because what may work for me today may not be suitable for you. What I mean by that is my investing and trading time horizon could be materially different than yours. I'm 31 years old right now. When I invest, when I look to buy something and hold on to it, I'm thinking about my retirement in 30 plus years. I'm not thinking about whether or not this is going to lead to me putting food on the table next week. But if you're, say, 65 or 70 years old, maybe you have a different perspective. Maybe you're actually thinking the earnings that I've now built up over a lifetime, that I've now saved and put into an account, I'm relying on this for my income moving forward now that I'm no longer working. So let's start there. Everyone has a different perspective to the market. Everyone in this meeting has a different time horizon from how they're approaching things. Everyone has a different risk tolerance. It's this collection in aggregate of decisions that form our marketplace. And because of our different approaches and expectations, when we get a piece of news, a speech, a data release, all of us interpret it differently. And when those expectations deviate far enough from consensus, that's when we actually see markets move. You know, you may find yourself in some situations where you go onto the daily effects economic calendar and you see there's an RBA rate decision coming up. And it looks like the Reserve Bank of Australia is going to raise rates. And you open up your notes and you see, okay, higher interest rates means a stronger currency. And so you go long the Australian dollar. And the rate decision comes out and they raise rates, but the Australian dollar falls. That may not make much sense to you. For me, that makes a lot of sense. You said it yourself in your analysis. The expectation was going into the meeting that they were going to raise rates. And so the market already has that as the base case scenario. It is already discounted and built into price. So what we're looking at when we talk about events and data, we're not necessarily talking about what the data will actually result or yield. We're talking about whether or not that release, that event, that speech is disparate enough from consensus expectations to present an opportunity for repricing. With that said, during normal market conditions, shifts in government policy, changes in central bank policy, economic developments, these tend to drive price action. And understanding, and I say normal market conditions, by the way, because we've just gone through a pandemic, a trading era, which is certainly atypical. At least the last time you can go find one that happened on a global scale, you have to look at the 1918 market, and there's a lot of differences structurally between global financial markets today and 1918, so it's not really a great corollary. But during normal market conditions, we look at things like interest rate differentials, whether or not the upcoming data will cause inflation to run higher or lower than expectations. Will that result in central banks changing policies? Understanding the contextual nature of data, when it's released, how often it's released, these will help you avoid being on the wrong side of a market. And I do want to warn you that this is not something that's suitable for everyone, right? I mentioned this before. Everyone has a different time horizon, a different risk management tolerance, if you will. Some people, because they may be younger, they may have a little bit more disposable income, they can take more risk. Others, if they are older, closer to retirement, don't have much disposable income coming in after a certain horizon, they may be a little bit more risk averse. So trading the news, a short-term trading strategy looking to capture shifts in unexpected movements or volatility, it may not be for everyone. And it may not be for everyone, more importantly, part and parcel because there's really no holy grail trading strategy. There is no single strategy to trading the news. You can see a whole different basket of mixed reactions, sharp spikes in one direction or nothing at all because people expected the data to resolve itself in the manner that it did. More times than not, it can simply be a guessing game as to whether or not the initial reaction will continue to follow pace or if it will reverse because of new sophisticated entrants coming up into the market. For most traders, the best thing can be to wait for confirmation. Be a little bit more conservative with your entry points in order to avoid getting on the wrong side of the market. And to a certain extent, letting the noise clear should provide a better signal so that traders can understand where prices are heading. Oftentimes, after a Fed rate decision, in my mind, I can think of numerous occasions over the last 5 or 10 years where you see a big spike higher in the dollar, then a big spike lower, and then we end up in half an hour later exactly where we started. While there was a lot of intraday noise, if you were looking to stake out a position or a swing trade, you could have found yourself ultimately on the wrong side because you took a false signal. And so when you're talking about these type of short-term based harnessing volatility news strategies, you're really not attempting to take out the position, right? You're not saying this is the moment where I'm getting structurally long euro dollar for the next 8 to 12 months. That's not really what we're discussing here. What we're discussing is looking for an opportunity based on a very specific reaction to a very specific event, looking for direction, trying to latch onto it. This is not really about an opinion over, whether or not the Federal Reserve should be keeping rates low, or is Brexit a good idea, or whether or not the, Italian government's going to stay together. We don't really care about those longer term things. We're solely focused on the short term. And when I say there's no holy grail, the point is that when we're approaching these markets, we're focused on risk management. We're focused on protecting our capital. We're not trying to predict the future or predict how the aggregate of people will react themselves, okay? When we say that event risk drives markets, when we say that there are significant reactions around data, this is empirical. This is not something that Christopher Vecchio at Daily FX believes. This is something that the good researchers at the New York Federal Reserve Liberty Street blog have put together. One such example of this is the drift in the S&P 500 around the Federal Reserve's rate decisions. Now, you may say to yourself, of course, Fed always pushes up stocks. Stocks are going to go up around every Fed meeting. That's been the case for the last 5 or 10 years. And I would say, aha, the measurement period for this study the Fed did was from September 1994 to March 2011, by and large missing the last decade of Fed-driven price action, and yet this relationship still reveals itself. On the day of the FOMC meeting, there is typically a run-up into said FOMC meeting from 24 hours ahead of time into the meeting itself. The day after the FOMC meeting, typically speaking, markets move sideways. On non-FOMC days, good luck finding significant price action in stocks. Stocks, while on balance positive, and it looks like we got our friend Michael Boutros coming in here with our Fed meetings.
Yeah, sorry, Chris. Mike, before we change anything, if you find that means you can go after Chris. We'll figure this out. Did we hear you?
We are. We're good to go. We're good to go, guys.
Okay, so Chris, sorry about the interruption, folks. Chris, keep going. We'll just adjust the times a little bit. Chris might go a little past the top of the hour. We'll figure out a break, but we'll get you there. Mike, you're up next. Don't drop that connection. Sorry, Chris, keep going.
No problem, and that's good news for everyone here. Michael Boutros is a great listen. I tune into his webinars personally every Monday morning at 8:30, so I know everyone here is excited to hear what he has to say. And quite frankly, Todd, I can end early, so I can listen to him earlier too. But as I was saying about these event risks driving markets, even on our non-FOMC days, while stocks may be on balance positive, and we know in the post-World War II era, stocks typically perform better than other asset classes, 8% plus gains on average per year against about a 13% standard deviation. You see here that we're not seeing much movement. Stocks have really become something that's clung to the Fed as a significant driver of price action. I like looking to specific events if we're looking for volatility in markets. It could be a Fed meeting, it could be a GDP release, it could be an inflation report. Last week, for example, we had US retail sales, right? Why would we care about that? Retail sales are a monthly indicator for consumption. The US economy, 70% of GDP comes from consumption. Ergo, retail sales are our best monthly insight into the largest component of GDP. Hence, we typically see some significant volatility around that release, especially when the release produces a result disparate from expectations. And so event risk drives markets. In between events, you don't see much of anything. If you think about the holiday trading period between Christmas and New Year's, not a lot of volume in markets, not many data releases, if any, not many speeches, if any, not many anything, if any. And as a result, you have quieter markets. There's no catalyst out there to provoke individuals to reassess their perspective, their beliefs on the market. So just from this first section, takeaways here. We all know that markets are not efficient. We're trading because we think that markets are not efficient, and we believe that there is some edge that we can get. I don't think barring access to inside information, akin to a Philip Lane scenario, most of us are only going to be able to outsmart the market by looking at disparities between expectations and reality. And we can learn those through fundamental analysis, looking at countries' macroeconomic indicators, companies' balance sheets, or through technical analysis. And so if we know that those are the premises of our approach here, then we need to do something perhaps even more basic, which is we got to find the right pair and the right event for which to trade. Now, before we even develop a trading the news strategy, we need to familiarize ourselves with the key event risks that are heavily impacting major pairs. And on a week-to-week basis, it may be cumbersome for some to go through the data, which is why we actually have done the legwork to discern what's important and what's not for you. And we do this through the Daily Effects Economic Calendar. This highlights fundamental developments coming out of the major economies. We're tracking from 100 to 200 events each week or so. And when you head on over to the Daily Effects Economic Calendar, you're going to find a setup that looks like this. You're going to find an area to change what time zone for which you want to find the data, country region for coverage. We cover 41 different countries / regions, and high, medium, and low importance. And this is to me where we're really going to want to look. Why? Well, high economic data, or high rated economic data, excuse me, those are the events that historically speaking and prospectively speaking are most likely to generate volatility in markets. How do we know that? Well, we've come up with this metric twofold. One, simply put, the number of alerts that are set for these events on the Bloomberg and Thomson Reuters terminals. The more people that set alerts for these data, the more interest there are. And so that's one factor. The more interest there are in these events by terminal users, the greater likelihood that we know people are making decisions based on these data. The second criteria would be the actual volatility. Which data events produce the most significant reactions in various US dollar pairs? So for Aussie dollar, for Westpac consumer confidence here, this would mean that the Australian dollar US dollar pair, among all Australian data events, this is in the top 10% of all price action and top 10% of all alerts set by terminal users, Bloomberg, Thomson Reuters, which means that we believe that this has a higher likelihood than other Australian data releases, relatively speaking, to move markets. We go over here to Japanese machine tool orders. even Danish balance of trade. No offense to Japan or Denmark, but we don't really care about these releases because one, other market participants don't. They have very few number of alerts set, and two, these releases do not generate a lot of volatility in the associated US dollar pairs. So why do we want to look at the high rated events? Well, at the end of the day, we're here to trade. We're trading the news. We're trading these data releases. We're looking for the opportunities when price action actually produces some action in price. And if we have an event that doesn't produce volatility and no one's looking at it, it's akin to a tree falling in the forest, doesn't make a sound. We want to be paying attention to the events that we know other people will be trading, and if there is a disparate outcome in the release, then we know that so many people are looking at this that it could provoke them to change positioning. If it's a short-term trade, to jump into the market. If it's a portfolio readjustment by switching their asset allocation within the currency space or across asset classes in general, that's really our prerogative here. Now, one thing that I wanted to do, which I did not have a chance to do right before we got started here, was pull up the economic calendar, but we're going to do that right now. And so we have ourselves here with the economic calendar. Let me know when you can see this. I see that it's now ported into the screen very well. For the next 7 days, you can see we have a bevy of high-rated events coming out. And a lot of these make sense. UK CPI or inflation rate, high. Euro area inflation, Canada inflation, all rated high. Why would that be the case? Well, think about this logically. What are central banks' main motivation? All central banks in the developed world have a price stability target. Some of them also have an employment target. But for the UK, for the ECB, for the Bank of Canada, their central banks only operate on a price stability target, which means that they care about inflation. And so if central bankers are looking at inflation rates to determine which way they will move interest rates, that means these data releases are very likely to naturally flow into policy decisions. And when we have policy decisions, that's when we actually have the biggest market moves. So speculation, repricing of potential market moves, potential policy decisions, that occurs around data releases that influence said policy decisions. So naturally, inflation releases by UK, Euro area, Canada this week, these will be things that have a high potential from our perspective to provoke significant price action in markets. We have a Bank of Canada interest rate decision coming up, Australian employment, Japanese interest rate decision, an ECB rate decision, among others this week, all of which are either directly related to policymaking or indirectly related to policymaking vis-a-vis being part of the main objective, the price stability target that these central banks are pursuing. And you can go through the calendar, as I was saying before. Let's say you're not interested in any data unless it's coming out of Australia. You can head on over to the Asia Pacific region. Just click on Australia. We can find everything coming out over the next 7-day window here. As we see, there's a mixed bag, right? Employment change high, participation rate low. So when the data comes out, more people are going to be looking at that employment change rather than participation, which also speaks to the fact that if we see employment meet expectations and one of these low-level indicators not quite get there, it doesn't necessarily mean that we're going to see a big market reaction. The high-level data needs to have that disparate outcome. Now, we were saying this before, we got to find the right currency pair. This is, you would think, intuitive, but for some people, it's not. For some people, they think like, okay, well, I want to find the pair that has the highest general volatility. And when you do those kind of studies, you're going to run across pairs like Aussie yen and pound yen, which have the highest historical realized volatility. But the problem is, we really want to trade something that's related to, the event's economy, i.e., if we're looking at US non-farm payrolls, we should look at dollar pairs like euro dollar or pound dollar. Trading euro pound or pound yen may miss the reaction to US economic data move, even if euro dollar and pound dollar are on the move, right? Let's just say, for example, both euro dollar and pound dollar rise. Sure, the dollar is down, but if they both rise by an equal amount, euro pound's going to go nowhere. And so, sure, euro was volatile around NFP, pound was volatile around NFP, but not in the place that you were looking. Again, this seems really intuitive. It seems very obvious, but a lot of people, they try to zhuzh it up too much. I don't really know how to have a phrase for this right now. They try to overcomplicate something that is really quite simple. Volatility appears in certain places at certain times. Yes, pound yen has the historically highest realized vol, but if you're trading something that isn't related directly to UK equities, UK economic data, Japanese equities, Japanese economic data, you're probably going to find a bigger reaction, a more meaningful reaction in a different cross. So finding the appropriate pair is crucial. And it's not just, okay, well, it's the dollar, so it's US economic data, we want to look at the US dollar. It's also the right dollar pair itself. For example, dollar yen tends to be more active than euro dollar around non-farm payrolls releases because there is a specific direct link between dollar yen and the interest rate mechanism. The Bank of Japan is pursuing this policy right now known as QQE with yield curve control. Doesn't really matter what that means. What matters is that they are keeping interest rates pegged and they are keeping their yield curve set at a very particular structure. They have a controlled market there. Because it's a controlled market on the JGB side, when dollar yen moves, it's more or less tracking the movement in US Treasury yields, i.e. when US Treasury yields go up because JGBs are unchanged for the most part, dollar yen tends to rise. And when US Treasury yields fall because JGB yields tend to be static, dollar yen tends to fall as well. So for an event like non-farm payrolls, which has a direct implication on Fed policy vis-a-vis the employment stability mandate, dollar yen tends to be quite active because US Treasury yields tend to be quite active. Whereas a pair like Aussie dollar or dollar CAD or euro dollar themselves, there could be other cross-asset implications there. Like, oh, the world's largest economy is growing faster, and that means there's going to be greater demand from its trading partners because US consumers are going to have more disposable income, and therefore they're going to, oil prices will go up, and they're going to buy more things from their immediate geographic neighbors. So the United States is going to import more from Canada. Maybe dollar CAD doesn't rise in an environment with a good non-farm payrolls report because people begin speculating on a stronger Canadian dollar, thanks to the fact that a country for which they derive 20% of their GDP and ship 70% of their goods abroad is now doing better on the labor side. The point here is that we want to be particular about finding the right pair. It's not just US economic data, US dollar, any pair works. We want to be strategic in finding the right pair for the right event. And for what it's worth, my colleague David Song does a report nearly every single day during the week highlighting the most important event on the calendar, looking at the most applicable pair. It's called Trade the News. He walks through the trading strategy for the most part that I'm about to outline here, which is not really a trading strategy itself, but a risk management strategy. And I can't be clear about this enough. Managing your risk is the first and perhaps only job you have as a trader. Your job is not to make money. I know that sounds counterintuitive. Your job is to take risk. It's in taking that risk, will you make your money? I want to know what kind of system you're using, right? Would you rather be lucky or good? For most in life, people say they'd rather be lucky. I'd say I'd rather be good because good is repeatable. Good we can replicate. Good we can put into a system and into a process that we can find those results consistently over time. That's what a good process yields, consistency. okay? And in managing risk, the goal here is to figure out a way to get consistently positive trading results. If we are simply just jumping into the market and choosing whatever the hot rated item on the Wall Street Bets Reddit subforum is that day, and for lack of better term, YOLOing out all of our life savings into weekly SPY calls, yes, we're taking a lot of risk. Yes, we're trading. Boy, if we don't blow up our account, we sure would be lucky. We don't want to approach things that way. It's exciting, it's fun, it's gambling. That's not our job here. Our job here is to develop systems, to develop strategies that allow us to take advantage of opportunities in the market consistently over time without leaving ourselves at a disadvantage for the next opportunity. That's how you should be approaching your trades. You should be thinking about, if I make this trade and everything possible goes wrong, will I be able to pick myself up and make the next one? And if the answer is no, then it's, of my opinion, from my experience and the education knowledge that I've gained over the last 31 years of my life, that's not a trade that you should take.
Chris, we seem to have lost
Develop
your.
a strategy.
Oh, there we go. You're back. Sorry, we lost your audio for a second.
Oh, sorry about that. Didn't even see an alert. So hopefully we didn't miss too much, but we're going to be talking about developing a strategy, right? Focusing on the risk management. That way we can ensure, at least to some degree, that we maintain control over how we are operating in the market. Now, like I said before, there is no holy grail strategy. There's no, set this indicator up, set this automated strategy up, and set it and forget it. Go to sleep. You're not going to find a trade the news strategy that passes the pillow test, because quite frankly, these should be isolated, contained events that in which you're operating. I really keep going back to this because I will tell you that there are some people that I've spoken to over the years who say, I was doing a trade the news strategy around the Fed meeting and it really worked out well. And it was working out so well that I decided to remove my stop in my second position. And 2 days later, I ended up turning out flat. I lost so much of my second position that it negated the win on my first. And I'm really bummed out because it actually would have hit my limit otherwise. Well, that's kind of the point. That happens because we're moving the goalposts. We have a strategy, we have a risk management system that is specifically designed for intraday volatility. It's not designed to be a 5-day, a 5-week, a 5-month, a 5-year investing plan. We're not trying to marry our position here. This is, we're swiping left for, talking in today's parlance. So we want to find a strategy at the end of the day that fits one's personality, and we can tailor to different market conditions. We want to be able to curb the risk of loss while broadening the scope for benefit and potential volatility moving in our direction. You'll find that some strategies involve setting up entry orders and stops ahead of time. Others are dependent on other calculations, but you'll notice that if you study strategies on the whole, when they are based around volatility, there is a sense of, one, careful prudence and attention needed, but also flexibility. And I say that, what I mean is you have to be willing to go with the flow. You can't be so rigid as to say, I'm not going to be patient. Yes, there's the whole cut your losses ruthlessly thing, but if the market hasn't moved against you and you're still within the time horizon for when you expect a strategy to potentially work out, you need to have faith in the strategy. And this is one of the problems that I've come across, and I know others will discuss this too, but when you set about a process or a trading strategy, if you take discretionary decisions while that strategy is still active, you are skewing your performance results, and you cannot properly measure whether or not the strategy performed as, say, back tests would have indicated. Because all of a sudden the strategy is not being followed. You're making your inserting your judgment, I call it your drunk judgment, because you are just imbued on and imbibing on your emotions in the moment. Am I making money? Am I losing money? Is the market going higher or lower? Is it meeting my expectations? How come I thought it would be better, but it's worse? What's wrong with my own internal processes? There's a whole bunch of things that go into the mix, and you can cloud your judgment. So we don't want to be there. We want to be diligent. We want to be flexible, but we don't want to be impatient, which is why we have this simple strategy that we've outlined here. My colleague David Song has put this together, has refined it over a number of years. I myself use this when I trade around specific news events, which is why I'm here discussing it today, because I think it's an effective risk management mindset when you are looking at an isolated event risk. And we've discussed step one already, which is selecting the right pair. Now, before even thinking about entering a trade, we got to consider what release is going to be impacting the pair the most. You know, the home currency should be in that pair. So if it's a US labor market data release, then we should have the US dollar in there. We talked about picking a counterpart, and if there's any trouble choosing a counterpart, that's why we regularly update these potential trade the news events in the Trading the News report. You can find that on the briefings page. Now, when we pick our currency pair, we do need to figure out whether or not the data or news coming out is better or worse than expected. It should theoretically be straightforward, right? Better jobs data, stronger domestic currency. And yet we go back to what we were saying earlier. Context is everything. David Song covers these in his Trade the News reports, but better than expected. Does this mean that the Fed is going to move on policy? Does this mean that we're going to get more stimulus, right? It's important to also have the broader understanding of what's going on in the market. Because if you don't, then you may find yourself frustrated. How come the market isn't reacting the way that I thought it would? You know, one of the important things that you need to do when you're observing a market release is seeing if the news did better or worse than expected. Because if the news is better than expected and the currency rallied, then it seems that people were just not in touch perhaps with how good things were. And if it does worse during bad data, then perhaps people have not been as pessimistic as they need to be. But we are looking to see if good equals good and bad equals bad. Because if upon good news, a currency doesn't rally, that's not necessarily something we want to be involved with. That means there's a lot of other forces and factors at play where we may not get a clean reaction around this particular event. And again, if a currency doesn't fall on bad news, there could be other factors at play, like I just said. So what I like to do is if I see a directional trade, right? We have better than expected US economic data, and now the dollar is rallying. In my head, that means market participants, we're not just not appreciating how good things have been, but perhaps the economy is actually improving faster than everyone anticipated. So on both sides, there's now a reason to reprice our current US dollar exchange rate. And so I'm going to be entering into this market with 2 units for a particular US dollar pair. And I say 2 units in particular because I want to be able to use one position for an immediate target, and I want the other position to give me more potential, more upsides. So when I get into the market with my positions, with both of my units, I'm going to have the same stop loss for both of these units. For the first unit, I'm going to set a specific target. Let's say, for example, I look at the non-farm payrolls report and I see that over the last year, the average pip range in the 2 hours around the non-farm payrolls report is 30 pips, okay? So that may mean I'm going to set my first stop loss 20 pips away, okay? Why? Because 30 divided by 2 is 15, and that means that theoretically the average move to the downside would be half of 30, so 15 pips. I'm going to set my first stop a little bit beyond there. That way, if we do see a deeper loss beyond, say, 15 pips, I begin to get a sense of direction. Maybe this is a position that's not one I want to be in for the long side. This is maybe a short side. All right. So with our approach here, we're trying to minimize our risk exposure. we're also trying to take advantage of any potential limited upside that goes in our favor at the very beginning. Why? Because if we do reach our first target, that provides us the opportunity, one, to take profit, but two, move up our stop loss on our second position back to its entry point, which effectively means that we've now guaranteed a profit on the first unit and we are working with house money on the second unit. I say house money because if we go and hit our stop loss, it's no loss to us. We do not lose money on that second unit. We've made money on our first unit. The trade hasn't worked out all according to plan, but we still have turned a profitable trade here. We want to be patient with that second unit, keeping open a potential target that's higher, no firm objective, so to speak. And this is where using simple technical indicators, like my colleague Michael Boutros will discuss. I typically would have referenced what he had already discussed here, but what he will be discussing, if it's a short-term moving average, if it's something like RSI or MACD or Fibonacci levels, right? Perhaps we see a breakout in a trade and there's a very key Fibonacci level coming up and we reach that with your second unit. Maybe that's the place where you want to get out of the market, knowing that that's a longer term resistance level. We want to leave an analytical ability open to find that second target. But with the first one, we are being very systematic. We are setting a stop. We are looking for our limit. Once we hit that limit, we are taking profit. And then we're moving up our stop loss on our second unit up to our entry point to avoid any potential losses. And a worst case scenario, then we've made profit on our first unit. We've come out flat on our second one. Not as great as it could have been, but we've contained our risk. And if you contain your risk, you keep your powder dry, right? And I know this is a corny saying. I really don't like it when Steve Leisman says it on CNBC, keeping our powder dry, but we don't want any single trade to be the reason why we can't take the next one. And if at any point in time, we find ourselves in a position that if it works against us, there could be no further positions taken in the future, we're taking on too much risk. Having a strategy to manage your risk is really important, which is why at DailyFX, we discuss this all the time. We produce articles and content highlighting different fundamental and technical items along with the implications for markets. We host live webinars sharing these key technical levels and trend and views on a weekly basis. We also publish fundamental forecasts on the daily and weekly basis. And you'll find all these things on our website, dailyfx.com, through various social channels like Twitter, Facebook, and YouTube. And of course, we support Nadex and IG with research and education through events like these and others. I know myself, I enjoy coming out to these particular events, get to interact with a lot of US clientele, potential clients that we normally don't get to do so on our daily basis. And it's a true pleasure. Our job here on the DailyFX side is to make you better decision makers, right? At a brokerage, quite frankly, we're the middlemen. We operate on turning over volume. I want to make sure that when you turn over volume with us, you are making money so we can have a long-term, mutually beneficial relationship together. And so if you have any comments or questions, feel free to reach out to me. Feel free to reach out to Michael Boutros after his session. We're both available at dailyfx.com. You could find me at CVecchioFX. You could find him at MB4X. Happy to talk with you through those social channels. Todd, I'm at 48 minutes now, a little long in the tooth here. Apologize for that.
Are we still good here on the mic? Yeah.
I think we're good with Michael Boutros now, Todd.
Yeah, I think we're all, Chris, thank you so much for that. And I appreciate your flexibility in being able to step up quickly and just rearrange the order of these. Everyone, let's take a 5-minute break. We're going to come back literally in 5 minutes. So just because I would like to take a quick little break. Chris, I'm going to take a presenter back from you. Give me 1 second here.
Hey, Todd, do you want to throw that on my end just so I can have that going?
Yeah, hang on once.
Did that work? Yeah.
Oh yeah, you know what? Here, let me do this. Yeah, that's fine. Let's just leave it right there. We'll leave it at that. Let's just step away for just 3 minutes. We'll start at 12:10. and we'll let Mike come back to the technical analysis intermediate. Chris, thank you so much for that. Everyone, let's take a 3-minute break. We'll come back and listen to Mike Boutros, and then we'll be right back on schedule.